Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 12th of January. Let's dive into the week's top market news. European equity rally and macroeconomic resilience. A comprehensive review of year-end 2025. The European equity markets concluded the final stretch of 2025 on a decidedly positive note, with the Pan-European Stocks Europe 600 index advancing 2.27% in local currency terms. This upward momentum was fueled by a combination of persistent economic optimism, robust corporate earnings, and a monetary environment that investors perceived as increasingly favorable. Performance across major national benchmarks was notably strong, led by Germany's DAX with a 2.94% gain and France's CAC 40, which rose by 2.04%. The UK's FTSE 100 and Italy's FTSE MIB also contributed to the regional trend, posting increases of 1.74% and 0.76% respectively. A significant driver behind this market confidence was the emerging evidence of a structural revival within the German economy, which appears to have passed its cyclical trough. In November 2025, industrial production across the Eurozone's largest economies surpassed analyst expectations. Germany, in particular, reported a seasonally adjusted 0.8% increase in output, starkly contrasting the 0.5% contraction previously forecasted by consensus. This industrial rebound was further supported by a massive 5.6% month-over-month surge in manufacturing orders, a figure that defied the anticipated 1.3% decline. Similar resilience was observed in Spain, where production accelerated to a 1.0% sequential growth rate, and in France, where the industrial contraction was more shallow than predicted. Consumer activity within the bloc provided additional fundamental support to the recovery narrative. Retail sales grew by 0.2% in November compared to the previous month, while the annual growth rate reached 2.3%, comfortably beating forecasts of 1.6%. This consumption data, coupled with the industrial pickup, suggests a broader strengthening of the Eurozone economy heading into the new year. On the inflationary front, the Eurozone achieved a significant milestone as headline annual inflation decelerated to the European Central Bank's 2.0% target in December, while the core inflation rate, which strips out volatile energy and food components, eased to 2.3%. Services inflation remained a point of concern for policymakers, settling at 3.4%. According to analysis from T. Rowe Price, the persistence of price pressures within the services sector remains inconsistent with long-term stability targets. Consequently, macroeconomic strategists suggest that the European Central Bank's rate-cutting cycle has likely reached its conclusion, as policymakers remain wary of the underlying inflation stickiness. In contrast to the broader Eurozone optimism, the United Kingdom's housing market displayed further signs of softening as 2025 drew to a close. Data from the Bank of England indicated a decline in mortgage approvals for house purchases, falling to 64,530 in November. This trend was mirrored in pricing data from Halifax, which reported an unexpected 0.6% sequential drop in house prices for December. This cooling of the property market is largely attributed to a combination of economic uncertainty and tax-related concerns, which dampened buyer sentiment and transaction volumes at the end of the year. Now our insight into alternative markets, strategic realism, and the DPI imperative, navigating the 2026 European private equity cycle. The European private equity landscape enters 2026 characterized by a profound sense of strategic realism. as the industry grapples with the lingering effects of high interest rates and a complex geopolitical environment. While 2025 proved to be a resilient year for capital deployment, with European deal values reaching a near-record €649.5 billion according to PitchBook data, the focus has now shifted decisively toward liquidity and the resolution of the exit backlog. The industry is currently at a juncture where the modest recovery in exits observed late last year must accelerate into a more robust trend to satisfy institutional investors. A central theme for the current year is the mounting pressure on fund managers to improve distributed to paid-in capital (DPI) ratios. With many assets from the 2017 to 2019 vintages approaching their natural liquidity deadlines, general partners can no longer afford to defer realizations. However, this necessity is complicated by a significant valuation re-rating. Assets acquired at multiples as high as 15x EBITDA during the 2019 to 2022 period are now often facing a market that prices them closer to 12x. This valuation gap has historically delayed exits, but analysts suggest that the urgency to return capital before launching new fundraising rounds will likely force a clearing of this backlog in 2026, even if it requires accepting more modest valuations. This environment has intensified a flight to quality, creating a stark bifurcation in the market between top-tier assets and more cyclical or plain vanilla businesses. Investors are increasingly bypassing traditional auction processes in favor of bilateral or trilateral negotiations to avoid the reputational risk of broken auctions. The focus has shifted toward companies with visible earnings, steady profit margins, and credible operational value creation plans. Consequently, corporate carve-outs, public-to-private transactions, and mid-market deals, where pricing remains more rational and exit routes are more diverse, are expected to dominate the transaction landscape. Parallel to this shift in deal structure is a fundamental evolution in how sustainability is integrated into investment strategies. The era of ESG box ticking appears to be yielding to a more pragmatic approach where sustainability is viewed as a core economic engine rather than a mere compliance requirement. Investors are prioritizing resource efficiency, electrification, and climate adaptation as secular megatrends that drive competitiveness and operational savings. In this context, sustainability is treated as the what of value creation, the core business model, while traditional ESG metrics are relegated to the how, serving as a framework for operational conduct rather than the primary investment thesis. Furthermore, the European market is becoming increasingly globalized, with US sponsors expected to participate in approximately 1 in 4 European private equity deals throughout 2026. The continent's reputation for attractive mid-market valuations and the prospect of accelerating interest rate cuts have made European assets particularly appealing to North American bidders. This influx of capital provides necessary liquidity and supports public-to-private activity, but it also amplifies competition for high-quality, resilient assets. As the year progresses, the success of European managers will likely depend on their ability to differentiate through deep sector expertise and a repeatable operational playbook rather than relying on the multiple expansion that characterized previous cycles.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.